So a lot of what we're trying to accomplish here is laying out the information in a format that's decision relevant, isn't it? It's taking what is oftentimes packaged in a rather haphazard way and packaging it rather tightly, whether it's ratios or the way we look at the income statement in terms of fixed and variable. And what we've done here with the balance sheet is we've really compressed it down and then looked as a measure of efficiency in those percent of sales numbers, where we're linking the assets we acquired to what? Sales. We took a look at where he is today at 600,000, and now we want to take a look projecting forward. And do you recall what Tim told us he thought he would need? 50,000, right? So let's see what he really will need. We've got a balance sheet here at 900,000, and what we want to do now is apply the financial gap process to this balance sheet. So we'll call it financial gap, but the tool we're going to use again is what? Percent of sales, the percent of sales. Now, you've got on one side, presumably on the left, you have where he is today, and on the right side, you've got the new balance sheet. This might be called build a balance sheet, huh? This is what this is really called. They've got build a bear. This is build a balance sheet. All right? And our percentage of sales, again, a measure of efficiency. A measure of efficiency, huh? And we're assuming, by the way, in our exercise here, that he will be how efficient next year? Just the same as he was last year. Is that a good assumption? I'd say it's a good beginning assumption. And then if we don't like what we see, what we might ask him to do, or we acquire some comparative data, we might ask him to become more efficient. We might, there's a role for both the borrower and the lender in this whole process of helping a business succeed, all right? So we've got, this is going to be 2 steps, okay? 2 steps. First, we're going to need a new net worth. We're going to need a new net worth. You've got the information there that he's projecting sales of what? 900,000. And what's his net profit after tax percentage going to be? It tells you at the top of your the 600,000 sales sheet. 3%. Net profit after tax we're projecting to be 3%. Whether it's 3, 4, we'll use 3 right now, okay? So we'll continue to use 3 for this, the current year we're looking at, or the current projection. Sales of 900,000, 3% will give us a profit of what? 3% of 900,000 is 27. And at the end of the year, if he does 900,000 with a $27,000 profit, when he closes the books, you remember, and then what? Whack. Where will that 27 circle around and end up? Right at the net worth part. What's his net worth today over on the 600,000 balance sheet? 286, and now he's going to make, coming in from the P&L, 27,000 more. You with me on that? Whack. So that's step 1. We've got to whack in the new net worth. And what is it? He started with 286 and he just made 27 more. You recall that it's cumulative from year to year. 3 what? 313. Okay, there's 2 steps and we just did 1. That would make us halfway. Now, the second step, follow the roadmap. Now, that's not the roadmap from section 2. That's this roadmap. We're going to go down the left-hand side buying the assets, across and up. And we're going to check whether the 50,000 that Tim thought he needed is correct. All right? Let's just build it. 4% of 900, somebody? 36. And I'm going to drop the zeros off just because then it could be any size company. Doesn't matter how many zeros there are, so I'll just use the 36. Somebody help me here on the next one. 18% of 900,000. Percent of sales. 162. Who? 162. Inventory, 26% of 900,000. 234. Total current, if I add them all up, someone? 432. 432, yeah? All right. 25%. 25% for equipment. Well, 900, 450, 2.25, right? 225. Land and building is typed in. What does that mean? Besides the fact that you don't have to write it. It's not going to change. In effect, what are we saying about this company at this point in time? He has adequate what word? Capacity. Is this always going to be true? No, it's not necessarily true. We could change, he could run out of space and we could add space. The real beauty of this concept is once we get down what we're doing, I mean, I'm giving you a set of assumptions for our company here. With your company, who provides the set of assumptions? You do. And what do we call that? That's your plan. We're going to take every element of your plan and be able to factor it into this balance sheet so we get a real good picture of what's going to be the impact on cash and capital. That's really what we're trying to accomplish here, is merge those two together so we don't get any gaps, any disconnects. No financial gaps allowed, okay? So his fixed assets, 225 for equipment, for the time being 120 for land and building. Total? 345. Now let's do them together. Total current, 432. Total fixed, 345. Total assets, 777. What does this say in words? I'm a big fan of being able to put what's going on in words, because if you can't put it in words, what does that mean? You didn't get it. Yeah. You didn't get it. What this says is when sales go from 600,000 to 900,000 at this level of efficiency, he will need how much in assets? 777. We're maintaining this same relationship. Now, we've bought the assets we need to support the sales of 900 at this level of efficiency. So we bought them. We're buying them right here. Now what are we going to do? No, we're going to cross over first. And we're going to pay for them coming up the other side. So what number's got to go here? Everybody knows that. The balance sheet has to balance. We took the accounting identity. This has been an accounting identity for years, hasn't it? Asset equal liabilities plus net worth. And we were able to turn it about 2 decades ago into a management tool. It happens to be one of my very favorite management tools because this is the area where most people don't get it right. And it's not because they're not smart. It's because there are some myths about how much money it takes to grow. People who can grow successful businesses and sustain them are geniuses. I mean, this is not we know that you got what? You got a 1 in 5 shot, first of all, out of the chute, don't you? So the odds are stacked against you from the beginning. If we can give people some tools to change the odds, that's really what Profit Mastery is all about, is giving people tools to change the odds more in their favor. And I'm guessing that there's not a business owner out there who wouldn't want to be able to use these tools once they've experienced how they work and how powerful they are. All right, so we went down the left-hand side. Now let's do what? Let's go up the right-hand side and pay for them. Follow with me now. This is where you can blow yourself up. Down, across, and up. Up the right-hand side, okay? Up the right-hand side. 777 of liabilities and net worth. The net worth part is 313. What is the total liabilities?
464.
For what?
464.
$464,000. Total long-term liabilities, 400 and what? $64,000. Is that right? Total liabilities, 464. Isn't that right? Total liabilities, 464. All right. Now, what are the long-term liabilities? What are they over on your other sheet? Let's leave them as 140 for right now, okay? We won't do anything with them for right now. We'll just leave them that way. Now, we know the total liabilities is 464. Oh, let me diagram how that worked just to make sure we're on the same sheet of music here. We went like that. Now, we're going to use this as a new total, aren't we? It says total liabilities. The long-term part is 140. So what is the short-term part going to be? If we know the total is 464 and the long-term part is 140, what's the short-term part? 324. You with me? This is not really very hard, is it? All right. 7% of 900,000. 63. The accounts payable of 15% of 900,000. Somebody.
135.
Who?
135.
135. All right. Now it's more complex. You must subtract twice. The total current liabilities is 324 minus the accruals of 63 minus the payables of 135. What does that leave? It leaves $126,000. That took us about 6 or 7 minutes to calculate. And yet I've had people who have said to me, you know, I got the profit plan okay, I could do that. I got the cash budget that we did in Section 4, I figured that out okay. I struggled with the balance sheet. Why? Because we don't typically pay attention to the balance sheet. But when we're trying to grow a company, it's the one we don't pay attention to that often eats up the company. We've got to pay attention to the balance sheet. We've got to be balance sheet managers, because then we are what managers? Cash flow managers, absolutely. You with me so far? So we're going to need, and what this says, let's put it in words. In order for sales to go from 600 to 900, at this level of efficiency, he will need an additional $126,000. What did Tim tell us he thought he needed? You knew this would happen, didn't you? He told us he needed 50. What do we know about Tim? No, he's not an idiot. He's normal. Most everybody guesses low. And what's going to happen if he asks for 50 and someone gives him 50, and then he does this? Somewhere in the middle of the year, he'll be back. And it's interesting because things could have changed, couldn't they? Things could have changed in the economy. Things could have changed in the world. It only takes one event, doesn't it, to change everything, the way people look at things, to change our attitudes. Things could have changed in the bank, couldn't they? Like what? Merger. The FDIC shows up, new manager. There's a lot of things that could change. And all of a sudden he goes back and it's not the same situation anymore. Well, I need it. Yeah. So, point being, I'm sure all of you, maybe many of you at least, have seen, I've seen a sign up on the wall of various businesses. It says, why is there always time to redo it when there was never time to do it right the first time? What we're talking here is doing it right what? The first time. If we need $126,000, let's go in and ask for what? $126,000. If we ask for 50, or if someone loans us 50, we're not doing ourselves and they're not doing us any favors, are we? Got to get it right the first time, and this is a tool to get it right. I know this looks simple. It is. That's the beauty of financial GAAP. There's quite a lot of fairly sophisticated finance wrapped up in this, but we took all of that out and just left a picture that was really easy to do. We've used all those four sources of money to grow as we went up the right-hand side, haven't we? How much new equity did we put in? Nothing. We didn't put any new equity. How much profits, retained earnings did we use? 27. You got it? You with me there? We used all those. Source of trade credit, we used all those, and who was left? The bank. We put them in red and said, there they are. Prettier. Still does the job. We wrote a software program that actually, when you do a gap analysis, if you come up short, it puts the number in what color? Red. This is a clue, isn't it, in finance? Red has a certain implication, doesn't it? Is it possible you could do this and come up with an excess? Yeah, what would that mean? Don't need any money. Do not feel cheated. If you do your plan and you were using a software program and it comes up green 126, what does that tell you? A 5-letter word begins with P. Now we can party, huh? All right, now the other thing we need to know, down at the bottom of that worksheet, we wanted to calculate a series of ratios. The ratios off the balance sheet, to give us a little bit of an indication, as we did in section 2, what's going on with the quality of the balance sheet. And we used the 3 balance sheet ratios, didn't we? What are they? The current ratio, the quick ratio, and debt to worth. Absolutely. Current ratio, the quick ratio, and the debt to worth. So what I'd like you to do is take a few moments and calculate it. Take a few moments and calculate it.